I want to invite guys who are going to be giving you some tips and let you step in their minds for 1 hour and see what they're actually looking when they're trying to make a decision whether to invest in a startup. So please meet Greg, who already saw on stage. He's going to be moderating this panel, and also Tim, who is from Silicon Valley, from Bootstrap Labs, as well Klaus from Intel Capital, Michiel, who is from Axel Partners, as well as Maxim. So guys, please stand up, give some round of applause for them.
Can everybody hear this now? All right. Well, so that was a little bit pessimistic before for my presentation, but generally, I'm an optimistic guy, and if you're going to be in this business, you have to be at some level an optimist. And so let's talk about 5 things that we really look for in startups. And as a prelude to this, we're just going to go around and just do brief introductions of each of the members on the panel. Shall we start here?
Hi, my name is Michiel Kotting. I'm Dutch originally. I started out in technology about 14 years ago, starting my own company, knocking on the door of at least 100 VCs before I managed to raise money. Today I'm a VC myself and have hundreds of people knocking on my door. I'm with Axel Partners. We started out in Silicon Valley 30 years ago and now have offices in the US, Europe, India and China, and in total 9 billion under management. We've done about 100 IPOs and 130 M&As.
Thank you, Michiel. My name is Max. I'm with 11 Startup Accelerator. Just like Michiel, I'm also Dutch, or partly Dutch. Also, very much like himself, started a business in the Netherlands, raised money, exited that business, and then turned to investments. Our fund was launched last year. It's a 12 million euro acceleration and seed fund, focused mainly on Southeastern Europe, but also on Central Eastern Europe as a whole. So I'm very excited to meet the startups that are today and tomorrow in Startup Alley. I'm very excited to talk about what we look for in investments. So switching over to Timo.
Yeah, I don't know. Yeah, this is on. Okay, cool. So I'm Timo Lehes. I'm an ex-entrepreneur as well. I started my first company in 1991, and I was a European VC before, and now I'm a US VC. So we think the landscape has changed quite a lot in Silicon Valley when it comes to how you do funding and the type of things that can be funded and not. And so we brought a new firm into Silicon Valley recently. And basically, we're looking for non-Silicon Valley companies that we headquarter out of the US and build them there to scale. And I can talk a little bit more about that later on.
Hello, my name is Klaus Conrad. I'm with Intel Capital. Intel Capital is quite a sizable venture capital investor. We did more than 100 investments last year. So we tend to invest roughly $500 million to $1 billion per year. Why does Intel do that? Why does Intel invest in young companies? I think there are 2 key reasons. First of all, we are interested to generate strategic value for Intel. And second, we are interested, of course, to make money as an investor. I cover the region of Central and Eastern Europe for Intel Capital, so including the Baltics, of course. I'm located in Munich and always happy to find cool, new, interesting companies.
There you go. Okay. So the topic is going to be to pick the top 5. So we've done the introductions, and I think we're just going to turn it right back around and have you guys each give that. I'm just going to just give a little further introduction for myself. I actually, the company that I started back in the day was one that didn't take venture capital and made it through to an IPO. But in the last 10 years, I've been very much in the venture capital realm and have been around some of these lucky startups. But for every lucky one, there are 10 that have to do it the hard way. And so both as a former entrepreneur and as an angel investor that often invests sort of earlier than these guys, I'm very much interested to hear what they're looking for, so I have a better chance of putting things on the runway that are going to be picked up.
So they asked us, what do we look for in a startup? And I think I would start by saying, as a former entrepreneur, it is very important for a startup what to look for in an investor. Because the most important thing in picking an investor is to make sure that what you want from your company and what they want from your company is well aligned. And so the first question, and which is at the same time our biggest filtering criteria, is how big is your ambition? Venture capital exists in all kinds of stages and sizes, and in general, the bigger the fund, the bigger the exits you need to really move the needle. So for us, with a $500 million fund in Europe, it is really important that the companies we invest in can be global winners. And therefore, we can sometimes invest in them very early and only invest 100,000, 200,000, or sometimes we invest very late, and it is in the tens of millions. But the main criteria that we have is the team there, does it want to be a global winner, and is it well positioned to be so?
Basically, I've become somewhat experienced lately at looking at very early stage teams. We launched our fund last year, and we have done so far 36 investments in very early stage startups in this region, in Eastern Europe. Basically, if I would have to give 5 things that we're looking for, I would break it down like this. I would give 3 core competences that I'm looking for, which is product development and design. Development meaning computer science, basically coding. And then there are 2 kind of transient things that a team must have at any rate, in my opinion. That is commitment and hustle. And a lot of people, I actually think that hustling is something that Europe doesn't always get right. Because, in many places in Europe, especially in Eastern Europe, hustling your way into something is considered obnoxious. It's considered, not a very nice thing to do. So the way I like to explain it very often to startups that are, have the ambition to apply with us or with any other investor, and to grow their product, with or without an investment, is that, there are certain things that you're good at. There are certain things that you're not so good at. When we look at teams at 11, we make sure that out of those 3 competencies that I mentioned, at least 2 are well covered, or at least 1 is excellent. And the stuff that you're not so good at, that's where you gotta hustle, which means that you gotta work your way in, and make sure that by simply overdoing it in effort, but once again without becoming an ass and without harassing people, you actually get things done. If you want famous examples, there are stories how, you probably know the Dropbox story, how the founder Drew and his team, how they got, a lot of people to sign up to their page just by posting a great video. There are stories of people who get engineers to work for them for free, et cetera, et cetera. That is what we mean by hustle. And my experience is that I haven't seen teams that have become really successful without the hustle element. And so hustle, clear commitment, not only on paper. If things go good, things go bad, you're still committed to the project. Plus, clear competences in those 3 very important areas. That's more or less, in short, what my idea is.
Okay, so we have a little bit different model. So basically, when I say that we're a Silicon Valley investor, we are still looking at European companies. So our model is to invest in entrepreneurs in Europe. Then there's a lot of talent in Europe. There's a lot of good engineers. There's an availability of engineers, relating back to Jason's earlier comment about, don't try to hire in Silicon Valley, which I agree with to 100%. But also we see that some of the ecosystems for actually building, let's say, an internet software startup really fast out of Europe has its challenges. So we don't see that the ecosystem in all the places are sufficient to take like a global leading role. And that's why we started a fund that's basically doing investments in European startups that want to headquarter and base their one of the founders, the main business functions out of Silicon Valley, linking up to the ecosystem there, while retaining engineering and all the rest of it over here in Europe. And we think that's a good model. To some extent, that's obviously a carbon copy of the Israeli model, etc. But so what we're looking for is really for entrepreneurs that are sitting in Europe thinking, how can I take the world with this thing, and what is the best platform or ecosystem for me to do that? And hopefully they know some people who either sold to some Silicon Valley companies, to some American companies, which is one way to kind of come to the conclusion that maybe I should go to Silicon Valley and build my company. Or they would actually know about us, and therefore they would contact us, which is very common. So we see a very interesting slice of deal flow out of Europe with people that are eyeing, towards Silicon Valley, and they come across and meet with us, etc. And then we have a dialogue about, what would it mean for you if you built your company as a founder based out of Silicon Valley while having your team, the R&D side of it, remaining in Europe. And that's the kind of companies that we look for. So it's a completely different slice of criteria from most people, I would say. But that's like the deal breaker aspect of it for us. And apart from that, there's tons of other things that we look for. But that's like the first one that I kind of want you to remember when you think about Bootstrap Labs.
When talking about venture capital, in my sense is a lot of times there is an assumption that it kind of might be a finance business, or there's an assumption it might be a lot about technology. Of course it is about technology in many cases, although not in all. And of course there's some financial part, but very, very small one. I think the key business, what this is about, is a people business. You mentioned that the ambition of a venture capital investor, especially with large funds, is to become big as a portfolio company. You're looking for those teams that have a chance to become really big. Now, on the way to become big, experience shows that you don't have an initial plan that you follow through all to the end. I mean, look at Intel itself. And Intel started as a memory company, right? And it was actually on the way that the company realized by accident that the microprocessor business might be much bigger. Look at Skype. I think they have tried it 4 times with different approaches and different products until they really had something that had the opportunity to become big. And on this way, on changing the path and adjusting to the opportunity, it's absolutely crucial that you have excellent people, an excellent team, and therefore you need an excellent leader. So I think what we look very much for is this kind of leader of a company, and the job of the leader is to get the best team, right? To get all the best people needed to realize that success. And I think the leader needs to be somebody that people want to work with, very simply, like that you find best people. And the leader needs to be a person that has the vision to build something big. And the leader needs this capability to communicate in a way that everybody understands what it is all about. So that employees understand what they're fighting for, that investors understand what this is about, and that customers and partners understand what we are talking about. So this is what I think we look a lot for.
Can I just ask the audience, how many people here know about AngelList? Okay, a few, all right. So in the last year or two, I've seen a big change in terms of the differing roles or the evolving roles of venture capitalists and angels. AngelList is a service that makes it a lot easier for your companies to get the word out about what they do and to raise that initial round. And I just wanted to sort of ask each of you, like, how do you see the world of venture capital and this intermediate range of angels and super angels working, and what advantages or disadvantages for both entrepreneurs and yourselves are coming out of this new evolution?
First of all, I think there's 2 very important developments underlying this shift that you're mentioning. And the first one is that developing a product is much cheaper than it was 15 years ago. when I tried to start a company. And this means that on relatively little capital, you can really build something up to show for. And the second thing, which is even more important, and which is very important to everyone in the audience here, is that the world has really become flat. And the next great thing can start anywhere in the world. You don't have to be in Silicon Valley to start a great company. You don't have to be in Israel to start a great company. At all the points in the geography, new ideas are born, new models are started up. So I think in the US, AngelList fulfills a very important role. There's very experienced angels that can not only provide the capital to people, but also the support, the network, the strategic insights to help people off the ground. I think in Europe, that is starting, and we have more of a second and third generation of entrepreneurs, but we would like to see much more of it. So because there's not that much going on in that range, there's a bit more of a gap still here in Europe. And so as a result, me and people like me, venture capitalists in Europe, kind of live on a plane and try to be with teams at a very, very early stage to fulfill a role that probably in the US is kind of filled by angels and super angels.
So regarding angels and AngelList, first of all, I'd like to share a story which kind of illustrates how powerful AngelList is. One of my friends, a great Croatian entrepreneur called Michiel Kotting, he's the founder of Farmeron. Maybe some of you heard about this company. The company went through Seed Camp, was then at 500 startups, then raised a pretty decent A round in Silicon Valley. Really one of those early stage successes to come out of Eastern Europe, and specifically our region, my region, Southeastern Europe. I've been fortunate enough to have known Michiel from the very beginning when he just started his company. I was there when he first pitched it to Seed Camp successfully. To cut the story short, basically what happened was that Dave McClure from 500 Startups, which many of you I guess heard about, one of the leading acceleration funds in the world, actually found Farmeron via AngelList. So as Michiel said right over here, the internet and specifically tools like AngelList create a very, very level playing field, and there is no reason, there was a lot of talk about access to capital. Certainly funds like my fund focus on specific regions like here to help the best and the brightest from this region to actually get right to that next level where you get a little bit closer to being globally competitive. But actually, if you once again hustle your way around it, tools like AngelList, anyone here in Lithuania or in any other place in the world, as long as you have internet, can actually connect to the best investors and the best customers globally. And there is no, to come back to that whole thing that you have to be somewhere. Definitely being in a place like Silicon Valley or Israel or any other great ecosystem helps. But to be sure, you can actually build your own success, and definitely AngelList is one of those tools that you can use for that. So yeah, definitely.
Yeah, okay, so I'm going to tag along to that. So I agree with you. So basically, what Dave McClure did in finding that company on AngelList, and them, obviously, did they work with 500 in Mountain View? Or? Yes, they were. Yeah, so really the point being that, once he actually found them, and like I said, there's a lot of talent out there, and once you get them to Silicon Valley and plug them into the ecosystem, they're pretty much in a much better position to build their company from there. So I think that's almost like a blueprint of what we do. I think our best example is Prezi, where they started in Hungary, a small team. They start building it. And Nikolai, my partner, starts working with them in Silicon Valley a few years ago. I was at another fund at the time, and they just managed to plug them in with some really good people like Jack Dorsey, etc. And then the thing just takes off through Axel and with the big A and all of that. So I think that is really the model, and that can be done, and that's what we do. With regards to AngelList, I think, back to what you said, Michiel, I think there's some really smart money in Silicon Valley, and we try to use AngelList to tap into that through with our startups. And so what we basically do is, obviously it's kind of a democratization of the funding landscape, you could say, because the information becomes readily available of who's out there and who's looking for money. But what we do is really to try to match the right advisor / angel with the right company. So for example, we have one company that's in the virtualization space, so we try to match them up with people that have built virtualization companies, exited, are now looking for the next thing, and that are really interested in those kind of things. So if they invest 50K, that's really smart money. If they invest 30K, it doesn't matter as long as it's them, and that's the key point. So there's some really smart money on AngelList. My experience is that in order to actually close a round with a fund in Silicon Valley, you need to be there. In order to close funding with an angel, you might get away with not being there, but I think you need to have some presence over there, otherwise it's just going to get too remote and too exotic for most of the people in Silicon Valley.
I think in Europe, for a young company, it's very difficult to find a VC investor very early stage. It's just a matter of fact that we have very few very early stage venture capital funds, and this even holds for the UK and for Germany. And then, of course, angel investors are a very, very important aspect of the ecosystem. Clearly, their fund size matches better needs of a young company. That's one aspect. But I think there is an even more important aspect how an angel investor fits in an early situation. So just imagine you have just created an idea, you have developed a business plan, you don't even have a prototype, nothing. For a classical investor, it's sometimes really difficult to evaluate the risk and the potential of this. For an angel investor, it might be different for two reasons. The case that happens most is that the angel investor hopefully knows you somehow, right? It might be a friend, it might be somebody from the family, it might be a friend of a friend. So they have some kind of a reference to you as a person, and by this already kind of reducing the risk in a different way. And the other way of looking at a very young company, of course, is specific experience in a certain field. So my recommendation sometimes to a team that only has a business plan is just look in that specific market segment that you are, which entrepreneurs have made an exit recently over the last 2 years. Just look in the internet who has made an exit, who has made some money, who knows that product segment very well, talk to them. Based on their very specific experience, they might just be very interested to support a team in that product segment.
Okay.
You know, if I could just react to that, you know, the thing always with talking about, you know, access to capital, how to find investors, one of the things that I'm always trying to make sure that, you know, a core belief of mine that I would like every single entrepreneur to understand, and I'm sure most of the guys here would agree with me, that the way it works for startups is that, you know, you guys, startups, founders, can go without investors. Like Greg said, you can actually build a business without raising money. We cannot be without you. We, you know, our businesses would be totally broke if we didn't have anyone to invest in. So what I'm always trying to work with my teams is to focus on actually getting traction with the product. You know, in economical theory, capital is a function and it follows markets. So the reason that, you know, there is a pretty decent, you know, although what Klaus said is true, there is still a lack of funds, certainly in specific stages in Europe. It is fundamentally true that if there is startup activity, investors will come. That's the reason we're in Lithuania today, because it's a very cool place for startups. And we will be in many other places today and tomorrow and all the other time. However, you guys got to build businesses, and what is really key is not to focus too much on selling to investors, because in the end, if you have an awesome business, investors will actually come knocking on your door. You know, I'm personally, although I get just like, you know, Michiel said, he gets thousands of emails all the time, and a lot of people looking for him. It's the same with me and with all of us, I assume. But in the end, the really good deals, we also have to fight for them. So it's you know, you know, don't get the impression from what we are saying here that it's you know, like we possess the power and you have to try to get it. It's many ways it's actually the other way around.
So one thing that has also changed just in the last few years is the type of capital you could raise, and when you raise what kind of capital. One thing that has happened a lot more, at least in Silicon Valley, is companies that are going for their first round are often raising convertible debt, and then they get some traction, and then they go out and raise their venture round. And it's almost becoming a sort of a formulaic approach. I don't know if it feels that way here, but it certainly has attractions for the entrepreneurs. It has attractions for the venture capitalists. And do you want to just talk about how that structure's working and what that really means to how things look from your point of view and how people should package themselves up?
Yeah, I think in general it's a good formula that works. Overall, we try to bring as much simplicity to the process as possible. Entrepreneurs don't like raising money because it distracts from the business. We don't like kind of being in the nitty-gritty. So in a very young stage, a convertible note is a good way to kind of do before an A round. There is some drawbacks to it because by putting a ceiling in, which everyone will do, you kind of effectively are already pricing the round. So there is some nuances to be aware of. I think what is more important to me, if you're facing this kind of early stage where you do your seed round and then you go on to an A round, is don't just show up at a VC's doorstep when you're raising money. Start developing a relationship earlier for two reasons. One, you can see which of the people you're interacting with really understands you, understands your space well, can be of use, has kind of interesting insights. And two, they can get to know you and be impressed, and you can overcome the issue like, we don't know you, we don't know your space well enough. So I think starting out the process of talking to people, even if you're doing an angel round first, even if you're kind of funding it through your customers first, is a very good process, so that by the time you get around to raising money, there's already more of a relationship.
Yeah, definitely. I can only attest to that. You know, as the niche of the investment business that I'm in, the early stage business, the seed fund, the seed investments, acceleration investments, as it grows, and it has exponentially grown in the last couple of years. Y Combinator was famously in 2005 the first one to start with this model. Then I believe in Europe it was Seedcamp that started in 2007 doing this, and then many more funds have popped up doing early stage investments. One of the things that happens recently a lot is that we get approached by people, very actually smart people, who are building tools to automate our process. Now, you have a couple of automations. You know, very often right now when you apply to accelerators or to seed funds, you apply via F-Success, which is a vastly used platform. You got AngelList, where you can also apply. For example, to 11, you can apply on both. That is, getting in applications. That is one thing, but actually very often we get approached by people who are developing models to predict which investment makes sense and which company will or will not be successful. And because I'm trying to get back on what Michiel said about making it a very easy process. At the end of the day, it's all about people. It's all about trying to figure out. This is always the game that you're playing. And I was just reading the book, which is called Launchpad or Lean Launchpad about Y Combinator. And it's the same thing that they're going through, and they have they invest in many more companies at a time than we do. They did one batch with 60 companies, I believe, at some point. You have a very short time to do the due diligence on a person. Technical due diligence usually doesn't matter so much because it's code that will be disposed of anyways. But you're trying to figure out whether those people will be whether they will click in the right way, and that's. By no means can I say that I'm getting good at it. No, not yet at all. But that's really the trick of the game in terms of traction.
Okay. Okay. So first, I'm going to relate to the question about the convertible debt, and so our model is actually to invest in convertible debt in the companies while they're European companies, and once we flip them to the US, we take equity in the US entity. So that's pretty clean cut for us. But once in the US. And if we were going to do, let's say, a seed round over there, then I see a lot of people using notes as a way to. So basically, a lot of times you don't know how long time it's going to take before you get interesting traction for an investor. So they open up a note and they go off on a funding round and they start building the thing and obviously try to build proof points, which is the right way to do it. But there's also like a due date on that. So if you you're 12 to 15 months in on your note. and you still don't have traction, that's a problem. So I think, end of the day, it's not an issue about notes. It's actually an issue with traction. And I agree with you. You can never build a tool that's going to predict, who's going to succeed or not. But what you can do is to be very diligent around how you present yourselves and your traction to investors, because that's what I look at. And it's like, yeah, but we don't have that good traction, so I don't want to show them. Yeah, but seriously, are you going to get past the first meeting with me without disclosing where you are in terms of traction? No. So it's like, to me, that's what I'm looking for when it comes to that aspect. So not that it relates directly to notes, but I mean, so once you have traction, you're going to get somebody on board that's going to invest, and they're going to price around, and then you're going to know the value of your company. So that's the way I look at it.
Yeah, I think you've made all good points about it. I mean, let me just give you 3 specific hints around convertible debt. First of all, it's about simplifying the process. In some cases, we have seen it that the convertible debt was so complicated that it did not simplify the process. They could have done an easy equity round instead. Point 2, there's a risk to make the convertible debt too small, and I think you touched on that point. So people are saying, look, it's just a convertible debt, let's make a small round, but then the company might not have sufficient time to really get to the next milestone. And point 3, sometimes there's a trap that the convertible debt, on the other hand, is so sizable compared to the next round that the equity investors later might be concerned to invest simply because a lot of their money just goes in repaying the old loan if the investors want a repayment, and sometimes they have the right to get a repayment. So keep that in mind, make sure it's really a convertible that converts, or just estimate the size of the next round and make sure you don't fall into that trap.
Thanks. I just want to. I hope. Am I okay? Another issue I just wanted to broach with each of you is, as entrepreneurs, you like to think that. As entrepreneurs, you like to think that it's going to be your company and you're going to lead it all the way through, but having been through a few of these, we often find that at some point in the company outgrows the entrepreneur, or there needs to be changes. And when you take on a venture capitalist at these A rounds, usually they're joining the board, and they're going to play a critical role in whether they're loyal to you or loyal to the company. And it sounds like a difficult question. You'd like to be loyal to both, but I just was going to ask if you guys wanted to comment a little bit about how you help the company and the entrepreneur finally get to that place down the road.
I would want to start by saying I think the big important distinction between early stage investing, which is what all of us do, and later stage investing, which growth companies and private equity firms do, is we all invest in the team and in the promise and in basically the dream, and we take a minority share. While if you go to a later stage company, they kind of buy you out, they potentially bring in an entire professional management team, they bring in consultants and to try to kind of improve the business for you. We're not in that kind of business, so we're always in the business of supporting the entrepreneur in realizing a huge dream. And sometimes part of that is enable a team at a point where the business grows beyond the level of their experience or competence, to kind of bring in bigger guns to help drive the dream further. As all of us invest in companies that, if everything goes right, reach 1,000 times the size of at which they are at the point that we invest. And in all cases, that only really works if it is in a good dialogue with the entrepreneur. And so sometimes you bring in someone strong to support Sometimes you bring someone strong that will be the new leader. Different models work for different companies, and sometimes you have a 19-year-old kid that leads a billion-dollar company at the end of the ride. So all variations exist, but our business wouldn't work if it wasn't for investing in a dream and building something together.
Yeah, absolutely. The way to look at it at this very early stage that we are at, as Michiel mentioned, is we are at the same side of the table. We're not obviously literally at the same side of the table when we accept a team, when we sit and negotiate or decide whether we invest in a company or we don't. But from the moment we work together with a startup, we really are like, I have a big problem if the motives and incentives are different. If something that's good for me is not good for the company, then we have a problem. If something is good for the company, not good for me, we also have a problem. To be honest with you guys, sometimes it's hard to keep that balance. Usually what happens is that after you've taken an investment decision and you got a team start working with you and you help them with what you can. For the first couple of months, let's basically, as long as there's enough money and the things are going according to plan, it's pretty easy to keep that balance, in my opinion, in my experience. Sometimes it becomes more difficult. We've had a couple of situations with over 30, some of the more than 30 investments that we had so far, where teams came to us to raise more money with us, where we wouldn't agree with that. We were heading off to a situation where it looked like, they would start thinking that we were actually against them, that they wanted something good, but we were there to not let them do it. And the coolest thing that you can do together in such a situation is when you can actually get to a point where, one of the parties convinces the other. Usually it's the investor that kind of is right at the end. But if I've had a couple of situations where we invested, for example, considerably less in a follow-up than the team wanted, and at the end they did something amazing during that follow-up investment period, and actually came to us and said, guys, thanks for letting us know about this, because this was a good decision. Sometimes it doesn't work out good. Sometimes we make mistakes. So I'm not trying to say that we are right about this all the times. But the worst thing in any rate, whoever is right or wrong, if the motives of the company and of the investor are not at the same line, then you definitely have a problem. Yes.
Okay, so my take on that is that it comes down to founding team composition. So I think you need at least two things in general. You need somebody who's a true entrepreneur leader and can build something and has the drive to do it, and basically cannot function in a normal organization. You just now need to go off and do stuff. And the other one that you need is a product visionary who can see where things are going. And by the way, both of those need to be able to code if you're working with us, or at least 3/4 of the team needs to be able to code. So I think there's a lot of constraints and criteria that we put on the team. But I think the biggest thing about putting in a CEO, for example, into a startup is that startups need to reinvent themselves all the time, especially in the beginning. It's like when you have you're not even sure about where you're actually heading, and so the guy who has the vision needs to run the company. I mean, I would not invest in anything else. And in situations where you put in a CEO who's basically an execution machine, and you head that in the wrong direction, that can destroy a company. So I think when you look at the types of companies that we want to build, they're constantly under threats from left, right, etc. Need to navigate and handle all the situations that basically need to be handled on a strategic level. And you can't do that with a machine CEO. So I think, I worked with a lot of really good CEOs for mature software businesses, but they're not always like the entrepreneur. I mean, you need to have that visionary who can basically tackle what's the best next step, the direction for where we're going. And then, obviously you need to have either in the same person or in the person next to you, somebody who can really build and operate something that gets really big. So, yeah.
Yeah, so let me start with the CEO. Of course, the easiest case is when there's a founder who is the CEO, and he can carry through the company all to the big event, right? To the big exit and even further. And that's the easiest case. And of course, there are a lot of these success cases that you all know. I've also seen it in Europe happening a couple of times. Here you have Ilya Lauers with Getchar, right? He was the first engineer, and now he's still leading the company very successfully. There's iMall in Czech, large e-retailer that we just sold to Naspers last year. He built the company as one-person team. Now it's a several $100 million revenue company. And there are other examples. Then also, you know, my experience is once a CEO feels that there should be a new CEO taking over because the company reaches the next level and he might reach the limits. In most cases, the experience is the CEO will come to the investors himself and ask for help. It's not the other way around. I think it's very, very rare that the board has to tell the CEO he has reached his limits. And otherwise, you have touched on the point, strengthening the team. Same thing. Usually, there is a discussion and the CEO says, look, I think we really need a new product manager, or we really need a business development manager, or we really need somebody to cover the US for us. Do you have an idea? And this is the value that investors should bring to the team. They should bring their networks and they should bring relevant people and introduce them, and therefore strengthening the management team as it is needed.
So that's on sort of the going inside. I also wanted to go on the going outside, on the exit side. I've been through an IPO, and it was frankly a lot less fun once we were a public company than I thought it was going to be. And I only lasted about 6 months, and we left. And part of the reason that Square and Twitter are not public companies today, or there's not such a mania, is that some of the people at those companies were at companies that went public. Dick Costello is at Twitter. He's had his company bought by Google. Ev Williams, the same. Jack Dorsey, and the same thing again at Square. And so venture capitalists look for an exit, and it can come in generally two forms, either a private sale or a public sale. And just if you guys would comment a little bit about that, and how you sort of view that, and how you work with the entrepreneurs and the teams to find that balance that's good for you, good for them, and just good all around.
I think that's very true. There is a balance there that if you take outside investors, they need at some point get a return on their money because they have raised money from other people that they need to return. But it's also very good to know that the average holding period that we have for our companies is 8.5 years. So there's a very long trajectory, and some companies go very quickly or are acquired very early. Sometimes when we don't want to sell them yet. So we, as often as not, we run into a founder who is already happy to sell the company at 100 million, while we think, well, it could be a $500 million company, why would you sell it? And sometimes we hold companies as long as 12 or 13 years. So it's a game where having institutional investors can help a CEO, because we've seen a lot of exits, we've seen a lot of these situations. And at the same time, for people in the company who have put a lot of blood, sweat, and tears into the company, built up equity, it's also important to become liquid on their stock options, etc. But the rule of thumb is very simple. If the CEO, the management team doesn't want to go public, you can't go public, and you don't want to go public, and it will be a disaster to go public. If a CEO or management team doesn't want to sell a company, there's no buyer that will want to sell a company. If the CEO wants to sell a company, it's really hard to kind of continue. So it's a dialogue. I think more of the power lies in the hand of the team than of the venture capitalist. What we hope to do is bring you a really fresh and good perspective of the pros and cons and where you stand in the process. And then if you decide to go public, through the network, with the bankers, with the lawyers, etc., that's required around it, help you set up the best way to do it, so it is less painful.
One of the so first of all, I'm not in a position to talk about exits. I have very limited experience. I had one personal exit, which was pretty small. It was a buyout by a couple of angel investors and my partners from my previous business. As I told you, our fund 11 is only launched last year, so we expect our holding period to be more or less in the same length as the case with Excel. So I've not done any exits from this fund yet. One of the things that I find very interesting to look at when I help my teams in their conversations with follow-up investors is the following. As a team, very much as Michiel said, you got to understand very well who your investor is, what they want, how they can help you, and what they're going to do basically during the investment period, and how they're going to exit. One of my recent experiences, I think, worth sharing. I went with a couple of my companies to Silicon Valley about a month ago, and in one of the conversations that I had, one of the VCs told me that we as investors, we try to diminish risks. So, for example, when we look at European teams that come from Silicon Valley, that come to Silicon Valley, for us it's an extra risky investment. So, for example, when in the United States we can insure our investments with acquihire, which is one of the common schemes. You basically, when you're doing due diligence on a team, you call up your friends at other funds and at technology companies, and you say, if things, or at tech companies basically, you say if things don't go well, for how much would you buy these guys? And if people give you a price which can at least cover your investment or get close to covering your investment, that is one of the extra insurances that you can get. And well, at least I could go ahead with that investment. For European teams, it's not always the case. It could be sometimes. That's why you have programs like Timo's that can actually help you build bridges in that way. This is just a very small example of how investors look at what they will do in the case of an exit in scenario A, scenario B, scenario C. So, this got me thinking. This kind of also helped me improve my strategy with follow-up investments in our portfolio companies. And I would suggest to anyone who is talking to investors to, it's a rule of thumb that you can read many blogs and many books that you got to do due diligence on your investors as much as they do due diligence on you. This is just an example that it's really true. I would definitely suggest, to keep that in mind.
Okay. So I'm in a similar situation. I have M&A experience, but never put anything on NASDAQ. So I'm going to relate to the M&A part of it. And I think one observation is that, M&A is a great outcome for a lot of startups and founders. And it's like you say, if they want to sell, then we need to look at a solution for that. Because that's you're investing in the people, and if the guy who's running it doesn't want to run it, you have a problem. So. But the interesting observation on the other side is once you go through an M&A process and you sell your company, all the people that I know that I've worked with are sitting with their calendar in front of them waiting for that 2-year day when the thing is locked up and they can leave the company, every single one. And they're like, they're on the day they're leaving that company, every one of them that I know. So it's like they love the financial outcome, but they just can't sit in a large organization. And in most cases, it's a large organization that's buying. That's one observation. So, you love the money, but, you don't love the company necessarily. In some cases, that's not true. That's one observation. The second observation is, well, I think for tech companies that have a very high rate of innovation and like renewal of their business, constant renewal and development of their business model, the financial markets and the analysts seem to have problems to kind of relate to that in a good way. So a lot of companies that list too early, they get hammered because they don't deliver on the normal industrial predictable model with really predictable earnings and turnover, etc. And the numbers are going up and down and left and right because you're still in a kind of a dynamic environment, and that seems to be quite difficult for publicly listed CEOs, but that's more like an observation rather than something that I've experienced.
An investor naturally is very opportunistic on the exit path. Whatever works best, they would take it, right? And also from the region, Central and Eastern Europe. We have done M&As, we have done a couple of IPOs, both NASDAQ, also Warsaw Stock Exchange, whatever works best. Sometimes the IPO path sounds very tempting. It sounds very shiny and very attractive, but there are some problems with it, and there are some issues with it. Just to make sure you're aware, first of all, typically financial investors on the markets, financial markets, just pay multiples on traction. They pay a multiple on revenue or on profits, right? If you sell to a strategic buyer, you might get a very, very different valuation if he has a strategic interest to get that unique asset. Point number 2 is, it can be a very, very painful and long process to go IPO. And don't forget all the reporting requirements, which is not only a time sink, but a huge cost sink. I mean, we had cases where like $2 million were put regularly on the cost side of a company just to come up with all the audit, reporting, and legal issues. And the third thing, as you mentioned, you get your money later, right? So you list a company, but the day you list it is not the exit. The exit is earliest when this lockup period is over, so the period the old shareholders are not able to sell. That might be half a year, that might be longer, and nobody knows what the share price is after half a year, right? So just, you know, to mention some of the risks and issues, as IPO sometimes is called the king way of an exit.
So we've got a little bit of time left. I think we might turn that over to let the audience ask some questions. And do we want to send a microphone around out there where I can give mine over? And you can ask directly to the whole panel or anyone individual. Folks? Any other closing comments from the panel?
Yeah, maybe just one comment to the area here, to the Baltics specifically. There is a couple of key advantages that you have here and that we are seeing as investors, and it's always good to build on strength. I think a strength here is excellent software development experience and skills. We are seeing that in a lot of teams, and it's really good to build on those strengths. A very big advantage also is that you can build a startup with not so high fixed costs, right? If you rent the same office space in Munich, where I come from, you might just pay 5 times the bill for the same space, right? I think it's also not a secret that the salary levels are different. And what that gives you is just much more time to work with your company with the same amount of money. So if you get a 1 million round, it gives you much more time to build the company until you reach the next milestone, until you have to go to the next funding round. And especially in young businesses where it's not so clear how the market develops, how your product develops, that can be a key advantage, and that puts you in a much better situation compared to many of your competitors, even over the rest of Europe.
Yeah, so my tip for anyone approaching with regards to funding would be, I think about it in very discrete steps. So the first thing for anyone who's like a software entrepreneur is like to just start build things and really do as much as you can without, even taking in any money at all, and just, go for it for as long as that's possible. So that's like step one. And really focus on what are the proof points I need to get a decent amount of funding, and not like Mickey Mouse funding, but actually a good chunk in the next step. Because that next step, if you can pull it off to basically build really good proof points and start to understand, and then later to also prove your growth model, and you start scaling your company, you show how that can be scaled up with money in the next stage, and there's like really good proof behind it, or I would say, indications that that's going to work. That's really interesting. And I really just try to hit as cool growth numbers as possible and just grow it like mad, while also having engagement, of course, because anybody can drive a front-end funnel and on acquisition. But make sure you have engagement, good numbers on that, and then understand your growth model and communicate that to us And basically, you know, that's the one slide you're going to need. It's like, here's our numbers, here's how we can grow it, this is where we are. That's pretty much most of what I need to know at the stage that we're investing in.
For me, you know, coming back to what Klaus just said, understand your strengths. You know, when I was looking through the booklet they gave us, the companies that are at Startup Fair today at this event, many of them are really, you know, very interesting. I met a couple already. Looking forward to meet the rest. But I do notice that there is this tendency to actually build things, if not for the local market, because I guess that even everyone understands that Lithuania is not much of a market. But you know, there are a couple of companies that were competing with. They were mentioning large Russian companies as their main competitors. You know, basically the thing is that if you're based in a country with a very with a great strength in engineering, and you have what do we hear today? The fastest internet. I also hear this about Bulgaria and Romania all the time, but definitely one of the fastest internets in the world. You have this great competitive advantage that you're both in the European Union and you're a cheap place to do business. There is, you know, you can compete with Russia. You can definitely build stuff for Lithuania, Latvia, Estonia, or any other country in the neighborhood, but you can actually be globally competitive. And you know, the tools, for example, that we were talking about today, like what Bootstrap Labs does by helping companies get to Silicon Valley, what we do by helping, you know, best teams in the region to actually get to the next level, and what of course larger funds like Excel and Intel do, you know, use those tools and actually do globally relevant stuff. The next panel, which I see the guys from the panel already sitting over there, they'll be talking about Israel. You know, in many ways, Israel is a great example in what a country with a total lack of an ecosystem can do in terms of becoming a global player. I think that in Europe we're actually on our way, but it really takes the startups to realize that you got to break out of this local the local paradigm and start doing stuff on a global level. And you'll see that it's actually more rewarding, easy, and I'm sure that everyone sitting right here will be more than happy to help you do that in terms of equity financing or convertible notes. So that's from me.
Yeah, I think we're very, very, very privileged, all of us, that we're living at a super exciting point in time where all the secular trends, explosion in mobile, in data, and everything, provides us the opportunity to go after very big ideas. So 3 recommendations for me. The first one is dare to dream big. And I think, like Maxim is saying, look at the global market. But one of the things here that has surprised me is very few companies go after Lithuania as their first market and then Russia as their second market. They kind of dip their toes more in, let's do something in Denmark or Sweden or something like that. Well, there's a huge opportunity next door where still a lot is very unexplored. So that might be controversial here, but I think it might be an idea. The second thing, I think, is iterate. And Timo was saying, in your company, iterate, start by building something quickly, find some test users, find someone willing to kind of pay for your product. But I would also see it in a bigger scale in your career. Pick an area you really love. Don't start just copycatting what is the latest idea on TechCrunch, but pick a subject matter and an area that you really love. Find some real world partners to partner up with. So if you bring the technical expertise, they bring in-depth knowledge of the sector, and then do a startup and fail, and do another startup and fail, and do a third one, and really become a world-class talent in a specific area so you can be successful over the longer term. And then the last one, it is going to be a very hard and exciting journey to build a company. And most people, myself included when I was doing my own thing, always have their sights set very high. And so whatever you do today, it's never enough. And there is another client that's bigger that you want to capture, or there's the next funding round you need to get, or there's the next kind of hires you want to make. Don't forget to celebrate success along the way. We were talking about an exit, and yeah, it's nice if 10 years down the line you can get the points on the scoreboard, but celebrate with your team, with the people around you in your ecosystem, the things that work well, because it's hard enough.
Hello, I have a question. In fact, two questions. So first one, how to contact you if you are getting 1,000 emails per day? And another one, are you available after this for a short chat?
The answer on contacting, just send emails. You know, I personally, I don't know about you guys, I answer everyone who sends something sensible. So sometimes I lose sleep over it, but email always gets replied.
And I'm just going to offer one set of closing advice from someone not here today. It was Kingman Brewster, who was he was the president of Yale. He was the ambassador to Britain, and he gave a convocation speech that helped me when I was in your seat. And he said, "I'm going to give you some advice from when I was your age." And he actually learned it not so much in business, but he said he learned it in relationships. And he said, but it applies perfectly well to politics and to business and really to entrepreneurship. And he said there's three things. There's only three things you have to know. And he said the first is to be bold. And so we listened. And he said the second is to be bold. And he said the third is don't be too bold. And so I think now that I'm on the other side of the fence and I'm looking at things, bold, and not too bold, that kind of fits around in the right spot. So thank you to the panel, and look forward to seeing the rest of you. And thank you again.